Ever wonder why a chunk of your paycheck vanishes before it even hits your bank account? That's tax withholding at work, a system most of us interact with daily without truly understanding. It's easy to feel like taxes are handled until tax season brings unexpected surprises. In this episode, we're demystifying withholding. We'll explore its purpose, how it operates, and why understanding it is crucial for your financial well-being. Our goal isn't just to explain. It's to empower you with knowledge for better tax planning and financial literacy. Withholding isn't a modern invention. It's a cornerstone of our tax system, designed for practicality and stability. Its primary purpose is to prevent taxpayers from facing an overwhelming single annual tax bill. Imagine owing an entire year's worth of taxes all at once. It would be a significant financial burden for most. This system ensures a steady flow of revenue for government operations throughout the year. For individuals, it acts as a continuous, small payment plan, spreading your tax obligation over 12 months. This approach significantly reduces the shock and stress of a large, unexpected payment due on April 15th. It's a practical solution that benefits both the government and the taxpayer. Historically, withholding gained prominence during World War II to fund the war effort efficiently. It proved to be an effective mechanism for collecting taxes from a broad base of wage earners. This method transformed tax collection from an annual scramble into a routine payroll deduction. It helps maintain economic stability by ensuring consistent government funding. For young adults and new employees, understanding this fundamental concept is key to financial literacy. It clarifies why your gross pay differs from your net pay. This isn't about optimizing your tax outcome yet, but about grasping the foundational mechanics of how taxes are collected from your earnings. It's about understanding the why behind those deductions. At its core, withholding is an estimate, not a final calculation of your tax liability. When you start a new job, you complete a Form W-4, Employees Withholding Certificate. This form is your primary tool for communicating crucial information to your employer about your tax situation. Your employer uses the information from your W-4, along with your pay rate and frequency, to calculate an approximate amount of federal income tax to deduct. They then send this estimated tax directly to the Internal Revenue Service, IRS, on your behalf. This process happens every pay period, ensuring regular contributions towards your annual tax obligation. The W-4 form allows you to adjust your withholding based on various factors. You can indicate your filing status, claim dependents, and account for other income or deductions. These inputs directly influence how much tax is withheld from each paycheck. It's a dynamic system, designed to be as accurate as possible given the information provided. However, it's crucial to remember that this is still an estimate. It's based on standard assumptions and the data you provide at a specific point in time. Your actual tax liability is only determined when you file your annual tax return, where all income, deductions, and credits are fully accounted for. Withholding is a prepayment, a down payment on your eventual tax bill. Withholding is a system designed for broad application, but individual financial lives are rarely simple. This inherent complexity is why withholding is often imperfect. The system aims for close enough rather than absolute precision, leading to the common occurrences of tax refunds or balances due. These aren't errors, they're adjustments. Life changes constantly, and the withholding system can't always keep pace automatically. For instance, if you get married, have a child, buy a home, or change jobs mid-year, your tax situation shifts significantly. Unless you update your W-4, your withholding might not accurately reflect these new circumstances. This can lead to over or under withholding. Many taxpayers also have multiple income sources, such as a second job, freelance work, or investment income. The withholding from your primary employer might not account for these additional earnings. Similarly, significant deductions or credits, like those for education or retirement contributions, might not be fully factored into your payroll withholding. The goal of withholding is to get you reasonably close to your actual tax liability. A small refund means you overpaid slightly throughout the year, while a small balance due means you underpaid a bit. Both scenarios indicate the system worked fairly well. Large refunds or large balances due, however, often signal a need to adjust your W-4 4 for better accuracy. For self-employed individuals, freelancers, or those with significant side income, the withholding landscape changes dramatically. There's no employer to automatically deduct taxes from your earnings. This doesn't mean you're exempt from taxes. It simply means the responsibility for tax planning and payment shifts entirely to you. Instead of automatic withholding, the IRS expects these taxpayers to make estimated tax payments throughout the year. These payments, typically made quarterly, cover income tax, self-employment tax, Social Security and Medicare, and any other taxes due. This requires a proactive approach to financial management and tax planning. Understanding this distinction is vital for financial literacy, especially for young adults exploring entrepreneurship or gig work. It highlights the importance of setting aside a portion of every payment received for taxes. Failing to do so can result in a substantial tax bill at year-end, potentially accompanied by penalties for underpayment. The obligation to pay taxes remains the same, but the method of payment differs. Self-employed individuals must estimate their annual income and deductions to calculate their quarterly payments. This demands a higher level of awareness and discipline compared to traditional employment. It's a key aspect of managing your own financial destiny. One of the most pervasive misunderstandings about withholding is equating it directly with your final tax bill. Many people believe that the amount withheld from their paycheck is their tax liability. This simply isn't true. Withholding is merely a prepayment, an installment towards what you might owe. Your actual tax bill is a comprehensive calculation performed when you file your annual tax return. It takes into account all your income sources, eligible deductions, and applicable tax credits. Only then is your true tax liability determined. The amount withheld throughout the year is then subtracted from this total. If your withholding exceeds your actual tax liability, you receive a refund. If your withholding falls short, you owe the difference. Understanding this distinction is crucial for effective tax planning and financial literacy. It helps you see your tax return not as a surprise, but as a reconciliation process. This clarity can alleviate a lot of frustration and anxiety surrounding tax season. It shifts the focus from how much was taken out to how much do I actually owe and how well did my withholding cover it. This perspective empowers you to take control of your tax situation rather than passively accepting whatever happens. A more constructive way to view withholding is as a convenience system designed to help you stay current with your tax obligations. It's not intended to be perfectly precise, but rather to be a practical mechanism for gradual tax collection. Small refunds or modest balances due at tax time are often indicators that the system worked reasonably well for you. For employees, optimizing your W-4 is a key part of financial planning. Regularly reviewing and updating your W-4, especially after significant life events, can help align your withholding more closely with your actual tax liability. This proactive approach can prevent large refunds, which means you've given the government an interest-free loan or unexpected tax bills. For the self-employed, this means diligently estimating income and expenses and making timely quarterly payments. Utilizing tools like the IRS Tax Withholding Estimator can be incredibly helpful for both employees and self-employed individuals. It provides a personalized projection of your tax situation, guiding you toward more accurate withholding or estimated payments. Ultimately, understanding withholding replaces surprise with context and empowers you to make informed financial decisions. It's about taking control of your tax journey, rather than being a passive participant. This knowledge is a vital component of overall financial literacy, enabling you to manage your money more effectively throughout the year. Don't let tax withholding remain a mystery. Take charge of your financial future by understanding how this essential system works. Review your W-4, estimate your income, and plan your payments. Visit the IRS website for their tax withholding estimator and other valuable resources. Empower yourself with knowledge and ensure your tax planning is on point.